Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. One thing we know about the future is nobody can predict it precisely. But today we'll get some insights on the things that are definitely uncertain and some things that are absolutely certain and how that can make you a better real estate investor. And we've got an awesome guest on the Real Estate Guys radio program. The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 20th to 23rd. Now in its 50th year, it's the nation's longest-running investment conference and features some of the biggest names in economics and investing, including James Grant, George Gammon, Danielle DiMartino Booth, Rick Rule, Lynn Alden, and Doug Casey. Plus, I'll be speaking in multiple sessions, attending lots of others. And the Real Estate Guys are hosting our annual invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make plans today to join the Real Estate Guys at the 50th Annual New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. And I'll see you there. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. A lot of folks in the financial world want to predict the future. Which way are interest rates going? What's happening to the markets? Real estate prices, are they up or down? What about new housing starts? The stock market, gold, silver, oil. Oh my. Well, today we're going to talk about how we can make moves as real estate investors in a market that gives us both uncertainty and certainty. Anytime someone's trying to predict the future, you can be pretty sure that they don't know for sure. That doesn't mean we don't listen to these folks. They have earned the right to have an opinion. They make educated guesses. They study. They look at past performance. They try to make their best guess about future results. And in certain investment markets, it's critical. When it comes to investing of any kind, there's two basic schools of thought. There's fundamental investing. Take the stock market. When you invest in the fundamentals, it means that you're paying attention to the companies, what their products are, who they serve, where their positioning is, where the industry as a whole is headed, and so on. And then there's technical analysis. Using the stock market there are traders that don't necessarily care what the companies do. They watch for the patterns that emerge as prices go up and down and as sales happen. And we do the same thing in real estate, but there's a lot less technical analysis in real estate and more fundamental analysis. So if you're going to be a real estate investor, you're interested in things like interest rates, population growth and migration, jobs, tenant-landlord law, taxation, asset protection, and property rights. And we can observe as these things change. Typically, real estate markets move slowly, sometimes so slowly you can be caught off guard. So how can you navigate an uncertain future? Well, I had a chance to sit down face-to-face with an old friend, and we were discussing some of these things. I thought, hey, it'd be a great opportunity for you to listen into our conversation. And because he lives in Alaska, while we've known each other more than a decade, we don't get to often be in the same room together. And while it was a bit noisy, I think you'll gain some excellent insights and perspectives as we talk with the host of the Get Rich Education podcast, our good friend Keith Weinhold, today on the Real Estate Guys radio program.
Hi, I'm Mark Victor Hans. You're listening to the Real Estate Guys. If you want to expand your consciousness, expand your wealth, expand your future, and have more delight and excite in your future than in your past, keep listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 28th year of broadcast. Lots to think about when it comes to real estate. One of the hardest things there is to do in any investment is to predict the future. We're going to talk about that today with our good friend and fellow podcaster, Keith Weinhold. How are you?
Robert, terrific. It's fantastic to be here with you in person.
Yes, I can remember standing there talking about your brand new podcast, Get Rich Education. You were going to have this whole new podcaster, and oh my gosh, it's blown up. You've been doing such a good job.
Thank you. That was back in 2014 in New Orleans when we shared that. And The funny thing, Robert, is back in 2014, I found myself having to describe to everyday people what a podcast is. I was always like, well, it's like an internet radio show where you listen through your phone. Luckily, I don't need to do that anymore with the Get Rich Education podcast.
No, it's great to have reach in a lot of places. And, you know, one of the things we've been talking about that I wanted to visit with about on the show is you're always looking ahead and analyzing the markets, and you get a bunch of great research and ideas, and you write on this as well as podcasts. But all of us are trying to navigate where the puck is going, and we don't always get it right.
Let's talk about the future. A lot of people think that they know the future with almost 100% certainty. About 2 years ago, almost everyone said an economic recession is coming.
It's coming for sure.
Certainty. In fact, one major financial media company in October of 2022 said there is a 100% chance of a recession coming within the next 12 months.
Right.
Well, that didn't happen. They didn't leave any opening for them to be wrong, and we still haven't officially had an economic recession.
Right.
Many people at the end of last year said, oh my goodness, how many Fed rate cuts are we going to have this year? Is it going to be 6? Is it going to be 7? Is it going to be 8? We're more than halfway through the year. It's been 0.
Yep.
No one saw that coming either. So really, the point is that no one truly knows the future. I was recently listening to Amazon founder Jeff Bezos, and Jeff Bezos said one of the more profound and insightful things about the future that I think that we can take some lessons from. Jeff Bezos, when he's interviewed, he's often asked, what is going to be different 10 years from now? And Jeff said the more insightful question is what is going to be the same 10 years from now. That is substantially easier to predict. So let's go ahead and steer our investor trajectory toward what is almost certainly going to be the same in 10 years. And there are a number of those things that are almost certainly going to be the same in 10 years that real estate investors can get lessons from.
Yeah, for sure. So I think one of those is we're surrounded by advances in technology every day. It's amazing. I don't see a technology coming down the road that's going to eliminate the need for human beings to sleep under a roof.
Exactly. And a term that you've often used on the Real Estate Guys is that housing is a non-discretionary expense. That's something that you've often discussed. So why don't we talk about that? Things that are almost surely going to be the same in 10 years that AI almost can't touch. VR, AR, machine learning will have a difficult time touching certain things, although we don't know where those things are going to take us. First of all, you and I are both going to be living in this same body, this same sack of skin and bones in 10 years, and so is every one of you listening. So I take care of my body first. I prioritize exercise. You touched on the second one. Everyone is going to need to live somewhere in 10 years. So that's why I like residential real estate as a sector. Now, there are certainly some other good sectors out there, but no one foresees the demand diminishing for residential real estate, whether it's multifamily or condos or townhomes or single-family homes or whatever it is. And another one is something that people consider to be an economic malady, but real estate investors can benefit 3 ways at the same time from another near certainty that we're going to have in 10 years, and that is inflation at whatever rate that is. So I think I could really help your listeners by talking about how they could benefit from inflation and near certainty 10 years from now through a lens that a lot of real estate investors haven't thought about before.
Yeah, inflation, and when it's kept at that Fed rate of 2%, is almost unnoticeable. But there's no doubt that you and I, everyone listening, and maybe more importantly, our tenants are really noticing that their cost of living is up. But to your point, inflation can benefit real estate investors.
Well, you touched on such an interesting word. That word is noticeable. Inflation is not a story until it becomes noticeable, and it became noticeable in everyone's Trader Joe's bill and every utility bill that you have in your life. It's become a noticeable malady since inflation peaked at more than 9% on a CPI level more than 2 years ago. Real estate investors are uniquely positioned to benefit from inflation, in fact, 3 ways at the same time when they buy income property with a loan. Don't just hedge inflation. A lot of people talk about inflation hedges. Hedging just means you're keeping even with something.
Treading water.
Why don't we structure things in a way such that we can profit from inflation is what I say. So when you buy an income property with a loan, you benefit three ways at the same time with what I have coined is the inflation triple crown. That's what investors win. The first leg of the inflation triple crown is asset price inflation. I think this is the one that we're most familiar with. If you have a $1 million real estate portfolio and you have 10% inflation over a couple years, your real estate portfolio is now worth $1.1 million. And maybe you're thinking, well, wait, aren't I right back where I began because I have 10% more dollars, but each one is worth 10% less? The answer is no, because we said you bought this with a loan. So you might only have, say, $300K of equity in your portfolio. Inflation took your $300K of equity up to $400K. That's a 33% gain. That's just one of three ways. The second of three ways with the inflation triple crown is with debt debasement. Say you have a portfolio of $1 million in debt, 10% inflation over time, only means you owe the bank back $900K of inflation-adjusted dollars. And with 10% more inflation, you only owe the bank back $800K of those diluted dollars, while your tenant makes the interest payment for you the entire time. And then the third way in the inflation triple crown is called cash flow enhancement. Experienced real estate investors don't even understand that if you get a 10% increase in your rents over time, because your biggest expense, your principal and interest, stays fixed, your cash flow might increase 20 to 25%. Imagine extrapolating that effect across your portfolio. So that's the inflation triple crown. Asset price inflation, debt debasement, and cash flow enhancement. And again, you do it when you buy an income property with a loan. It's a formula that you, the listener, are probably already familiar with. You're probably already buying properties that way, but you probably didn't realize that you benefited from those three ways at the same time.
That is awesome stuff. And then, of course, all the other benefits, right? The fact that you are providing clean, safe, affordable housing to real people. The fact that our government and most governments give us tax incentives to invest. There's a lot of reasons to love real estate. But I think getting back to this idea that we don't know where the market's going, let's talk about, Keith, how do you navigate deciding where and when and what to invest in when you're not certain that things are going to go a certain way?
Because all you do know is you don't know. Right. Investing in multiple markets is a key thing to do. You probably want to invest in multiple real estate asset types as well. I like residential, but when we talk about primordial human needs, agricultural, raw land, they can be other important ones. But because you don't know what's coming, you want both diversity of asset type and a diversity of multiple geographic markets. And it's funny that I would mention this on your show because this is something that I really first learned from you, because the Real Estate Guys radio show is the first ever podcast that I began listening to back around the year 2011. So you don't just want to be in one market or one property type.
You know, I think people have this idea that real estate everywhere is like it is where they are. And if you live in a place where the numbers make sense and there's a good supply of renters and good properties, then that can make sense. But, you know, I've always said, live where you want to live, invest where the numbers make sense. You live in Alaska, so there's some possibility to invest there, but to get exposure to other markets, you do have to be strategic. So what are some of the ways that you approach picking a market?
I like to pick a market that has a broad diversity of economic sectors. You mentioned Alaska, Anchorage. It has a narrow diversity of economic sectors. So much is concentrated in the oil market. So you really, ride the fortunes or misfortunes of the oil market. So generally, bigger metropolitan markets make more sense. I don't want to be invested in a town of 8,000 people that's far from a metro area where 40% of that town's employment is in the tungsten mine. Nothing wrong with tungsten, but now so much of your fortunes and the source of your income are tied to what's happening in the tungsten market. That is really risky. So being in a broad market with wide economic sectors are what are really helpful. Distribution is a great one because distribution jobs, like what we have in Memphis, they're difficult to outsource because that's fixed to the geography that's there. Medical, technology, these are sustainable sectors. So bigger markets that tend to have a disproportionately high amount of economic activity in those sectors, they're the places that I like. And we also know that a lot of these markets tend to be in the United States, Midwest, and South, because that's where you get a high ratio of rent income to purchase price, and that's where you get laws that favor the landlord more so than the tenant.
Which is a really good point. Now, this does tie into the conversation about the things we know are going to be certain 10 years from now.
Yeah.
And to your point, a market that has distribution like Memphis, hard to move that infrastructure, right? Really difficult. But in these smaller markets, even though you might find a great opportunity short term, if it is tied to one industry or one company, that makes it a little more risky. So the diversity for sure. But if we can kind of follow the lead of these areas we've identified that we expect not to change that much in 10 years, there might be some secrets there.
Yes, that's right. You can also follow what the leaders are doing. You don't have to be original. It's the pioneer that gets the arrows in their back. We both know and chat with Ken McElroy an awful lot. What product types is Ken McElroy getting into? If you don't know, where is Ken going? What are some of the states that he likes to invest in? Why does he like Arizona and Texas and some of the southeastern markets increasingly, where the population is going? So you can just really, follow what others are doing. Being a real estate investor is an entrepreneurial venture, but you don't have to go out on a peninsula by yourself as often as you do in a lot of other industries. You can sort of follow a plan of what others have done previously and really, look at your kind of mentors and people you look up to and see what they're doing. You don't have to come up with it all yourself.
Love that. It's a shortcut. My dad used to say you don't have to give natural childbirth to ideas. You can adopt. And in real estate, we also have the benefit that the markets don't move lightning fast. Right? There's folks today trying to play the flash trade, trying to figure out is NVIDIA up or down. In real estate, it's the long-term, slow-moving nature of it that sometimes turns people off, but I think creates that ability to build long-term, predictable wealth.
The slow-moving real estate market, that can be a good thing or a bad thing because you can get lulled to sleep. And if a market begins to turn and it begins losing population, you can say, I'll deal with that someday. I'm occupied now. I don't need to worry about it. It can be pretty easy to get lulled to sleep because real estate moves so slowly. And there is no panic trading in real estate, which can be a good thing because that's what helps lead to stable prices. That's why there's not much volatility in real estate. It does move so slow, and volatility can be deleterious to returns over time. So you're really in a stable, proven asset class. It moves so slowly, so embrace the positives, but don't get lulled to sleep. Oftentimes you have to ask yourself the question, if, say, you have a portfolio of 12 properties, would I buy all 12 of those properties again if I could or not? Because this one market where 3 of the properties are is looking pretty tenuous. Those are probably the 3 to think about moving along on.
Yeah, zero-based thinking, knowing what I now know, what I do it. We often say you get married to a market. Unlike a stock where I can buy based on what I like in the fundamentals or even the technical analysis, I don't pick a stock based on where the company is geographically located. But real estate, I do. And to know a market well enough to make investment decisions, it takes some time. So you really do have to learn the market, learn the nuances of the market, meet the right people. Talk about the importance of getting the right team on board with your investments.
The market is more important than the property. The team is more important than the property as well.
Yeah.
And we can think of our team members from someone more niche, like your 1031 exchange qualified intermediary, to your mortgage loan officer, to that all-important property manager and that relationship with that property manager. They're the glue that makes this entire thing stick together. So a bad manager will drive a good property into the ground, and vice versa with a good manager. The team is more important than the property. The market is more important than the property. And intrinsically, you, the listener, You already know this because a 500 square foot studio apartment in Manhattan is extremely desirable and it will be costly because the market's more important than the property, but you could have a beautiful sprawling mansion in a swamp in Appalachia and it's not going to be worth much. The market's more important than the property, and so is the manager. And you've actually given a good framework for this before. You need to get the hierarchy in real estate investing right. The property is only the fourth most important thing. Number one is you.
Yep.
The second is the market. The third is the team. And the fourth is the property. Most people get it 100% backwards. They fall in love with the property. Then they realize they don't want to manage a tenant and get texts from tenants. So then they try to figure out, thirdly, if there's a good manager in that market. And then they go up to number two and try to figure out, did they even buy in the right market? And then they go back to number one, which is you, the investor, and does this even fit what I wanted this to do for me in the first place? Most people go 4, 3, 2, 1. You want to go 1, 2, 3, 4.
And part of it is you have to go out and try something and do something and get that feedback. And then depending on how it goes, you make adjustments. Our guest today is Keith Weinhold. We've got more to talk about with Keith when we come back. And we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from December 6th to 9th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, the top tourist market, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me December 6th through 9th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates, as well as travel details. So join me in Belize, December 6th through 9th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hello, this is Robert Kiyosaki. I'm the author of Rich Dad, Poor Dad. And if you're serious about learning how to invest in real estate, listen to the Real Estate Guys. They really know what they're talking about.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, join me in beautiful Jacksonville, Florida, as we check out the market and some local markets. Learn about what's going on, the sustainable drivers, where population and jobs are going, and tour some awesome real estate. Plus, you're going to be exposed to at least one new home builder that can offer financing at 4.25%. And you'll meet a bunch of awesome Real Estate Guys listeners. You get all the details on the website at realestateguysradio.com under events, where you'll see the Jacksonville field trip. We're talking today with Keith Weinhold, who's always got great insights on real estate investing. Before we get back to that conversation, it's time to play Real Estate Trivia. That's your chance to win a prize by knowing today's Real Estate Trivia question. When you hear the question and think you might know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Send us your name, the answer to the question, and your physical mailing address. If you're the first to get it right, you're going to get Ken McElroy's awesome book, The ABCs of Buying Rental Property. That can be yours if you know today's real estate trivia question. The show took a bit of a breather last week for family vacation time, but the week before we asked this. 2023 was the highest year yet in the U.S. for total annual revenue when it comes to short-term rentals. How much gross revenue was that? Well, lots of good guesses. The answer, approximately $64 billion. That is a lot of overnight revenue. Here's our real estate trivia question for this week. Name the only U.S. state where it's illegal to pump your own gas. Yep, everywhere else but this spot. In the U.S., you can self-serve, you can grab the pump, but in one U.S. state, you can't touch it. Which state is that? If you know, or maybe you live there, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, your guess, and your physical mailing address. The first person that gets the right answer gets Ken McElroy's most recent book, The ABCs of Buying Rental Property. That's today's real estate trivia question. We're talking with Keith Weinhold. He's the host of the Get Rich Education podcast. And Keith, I'd love to go back to your first investment. You know, listeners to our show, like many of the listeners to your show, they haven't yet pulled the trigger. They're listening to our podcast because they're trying to get more information so they can make an informed decision. You've been investing in real estate, studying markets, you've got your mind around this stuff. But way at the beginning, take us through the story of how you got interested in real estate and what did you invest in to start out with?
I'd like to talk about how I got into this because what, are you just born a real estate guy and you're just a real estate guy through and through and you know all this stuff? No.
Nope.
I grew up in Pennsylvania. My parents had yellow National Geographic magazines on the bookshelf. I was a geography lover. I'm a lover of maps and globes and world travel. That turned into a degree in geography. Shortly after having the humble bachelor's in geography degree, I found myself doing construction inspection for highways.
Wow.
It paid somewhat better than average, but, you know, I was doing something that did not align with my soul.
Yeah.
Trading my time for dollars, selling my time for money, and I just thought, there's got to be a better way than to spend my most productive, energetic waking hours doing something that my heart is not into.
Right.
I found myself hanging out with an aspirational crowd. 2 of my 5 closest friends, just like Jim Rohn says, you are the average of the 5 people that you spend the most time with.
Yep.
2 of them made their first ever home. You know, we're getting into like when you're talking about stopping being a renter and becoming a homeowner. They made it a 4-plex building where they lived in 1 unit and rented out the other 3. This was about the same time that I read Rich Dad, Poor Dad. And what I learned, and my friends made it approachable from what had seemed intimidating, that I could buy an entire 4-plex building with an FHA loan and just a 3.5% down payment, live in 1 unit for 12 months, and have a minimum credit score of 580 That's all you need at last check. And here's the good news, and something very actionable for you, the listener. You can still do that today, what I just described, with a single-family home, duplex, triplex, or fourplex. It's a great way to begin with a bang. With that first fourplex building, with very little of my own money, I use cash-out refinances and 1031 exchanges to grow that portfolio in my local market and then learn that the best deals are in other markets to go from there. So that's how I began. That's how I took ideas and turned it into action, and so many lessons came really just from that first humble fourplex building.
Absolutely. My first property was a duplex. I lived in half, rented out the other half. My first tenant was my sister. She moved out and I got a real tenant. Then I moved out, bought another house and kept it. And my original investment philosophy, as you probably know, is just to keep buying real estate. And then I had a mentor who said, Robert, why would you keep a house as a rental just because you lived in it, rather than strategically look for the type of residential property that is in the path of progress, is in landlord-friendly states, all those things. And I'm like, wow, mind blown. And so I got more strategic with us. So take us from that first property where you lived in it, you had your tenants living with you, until you started to build a portfolio outside of the same area.
And that is a weird experience, having your tenants live with you. Your neighbors are people that you also have this tight financial relationship with too. What I learned, Robert, in order to grow my portfolio is I need to think through a new paradigm. I think a lot of people, they might move out of that fourplex, and when you do that, you go from 3 rental incomes to 4 because you just vacated one of the units. They might be happy keeping a small portfolio and trying to pay that property off or pay that property down. And that's not completely wrong, but that is antithetical to growing a large portfolio. Instead, what I did is I did a cash-out refinance. Held on to that building and moved a portion of that equity from that property that I separated from that first fourplex into a second fourplex. Now, this broke a few paradigms for a lot of people. Financially free beats debt free. I took on more debt when I just did that. Rather than pay down my fourplex, I borrowed more debt against it in order to buy a second fourplex. We talk about financially free beats debt free. I just moved from 4 income streams to 8 income streams, closer to financial freedom and further away from debt freedom. I'm not averse to debt when I know that tenants and inflation passively pay off my debt for me. I don't want to get actively involved in paying down my own debt. Financially free beats debt free. That's one of the paradigm busters that got me to grow my portfolio. When I pay down a property, my portfolio is in essence collapsing rather than expanding. There's an opportunity cost to paying property down that you could leverage into buying more property. That mindset shift is what helped me grow.
Well, and when let's say you wanted to pay off your loan, well, you just eliminated part of the Triple Crown. So instead, we want to use leverage to our advantage, which leads to the part of the reality we're in, that interest rates have gone up a lot and quickly. And that has certainly hampered, in many ways, people's ability to get in. But what are you seeing in that regard? Ken and I talk about this a lot, the fact that over the life of our investing career, we're almost the same age. We've been investing in real estate the same amount of time, and the average interest rate we've paid during our entire investment careers is higher than today's rates.
Yeah.
Right? He pointed that out to me. You've been investing at a period of time where rates have come down, and now are headed back up. What do you have to say about that?
That mortgage rates are historically about normal, but to your point, no one really wants to talk about it that way, and no one really acts that way, that mortgage rates are normal. Mortgage rates absolutely matter, obviously. It's really mattered to those that did not have long-term fixed interest rate debt. We've all seen that with some maybe real estate syndicators that didn't just get things structured quite the right way, although savvy syndicators are doing just fine. One thing that I think about with rates is how it really is paradoxical to some people, and you might have a little bit of a difficult time believing this. There's what typically happens with home prices when mortgage rates go higher. Historically, home prices go Higher, not lower. And most people say, no, what do you mean? When did that ever happen? Well, we just came off a period where mortgage rates tripled, yet home prices were higher. In fact, mortgage rates increased 1% or more 8 different times in the last 30 years since 1994. Of those 8 times, I'm asking you, the listener, how many of those 8 times where mortgage rates rose do you think home prices rose? The answer is 8.
All 8.
All 8 times. And a lot of people are like, well, wait a second. Doesn't anyone know that when mortgage rates go higher, that impedes affordability? People can afford less, so prices go lower. That is actually a rather intuitive way to think about it. But economics are often counterintuitive. We have to think about what's going on in the world when mortgage rates are increasing. Typically, we have higher inflation, we have high employment, we have a thriving GDP, and higher rates are confirmation that the Fed and the powers that be are saying the economy's really good. When the economy's really good and rates go higher, when people are fully employed and they feel secure in their job, what do they feel like doing? What are they more likely to do? Buy a home, increasing demand. So that's why higher mortgage rates actually correlate with higher home prices. Most people think that it's lower.
Now, today, of course, we have our inventory of homes at not an all-time low, but lower than it would be, and yet prices continue to do well in some markets. We're seeing a little bit come down from that in other markets. But how does that affect your decision to select a new market or double down maybe in a market you're already in?
Yeah, you bring up something really important. You keep bringing up markets. Of course, we want to be attentive to the inventory and the supply in individual sections. Texas and Florida have a supply of housing that's beginning to get ahead of the relative supply in other parts of the nation. Doesn't mean those are bad places to invest in, something we need to be attentive to. Of course, there are different areas within each of those states as well. And that's part of what's kept this housing market afloat, that supply continues to be low amidst demand. You can look at all sorts of statistics and numbers, but the available supply of existing homes per a Fred data set that I like to access, 2 years ago it bottomed out that we only had about 1/4 of the supply of existing homes that we need. Today it's half, so it has about doubled, but it's still only about half of what it needs to be. But when supply begins to exceed demand, that's when you want to get more concerned about a softness in prices. But we haven't seen that from most any standpoint that you look at. We have about 3 months of available inventory in most markets, where 6 is more common. So we're still in a rather safe zone that way.
One of my favorite things about real estate is the inefficiencies of the market. If you're a stock investor, there's nothing you can really do to change the price of a particular stock. It is going to sell today at what the market says it should. But in real estate, we can exploit a lot of different things. One is knowledge, knowing something about what's happening in a market that the other person doesn't. One is the seller situation. They may be overly motivated. So how do you see that fitting into being a real estate investor compared to folks that are investing in more perfect markets?
Yeah, you're right. There aren't very many desperate sellers right now. That's an important thing to keep in mind. Asset values of most everything are floating high right now, but in real estate, a lot of sellers aren't very desperate. It's really going to be difficult to snag a deal because you have a low proportion of distressed sellers. The delinquency rate, when you look at pre-pandemic numbers, is still not high. Sellers have tons of protective equity. 40 to 45% of American homeowners today have no loan on their property. They're free and clear. So you just don't have a great deal of desperate sellers today, especially with the interest rate lock-in effect that everyone is aware of. We also have a capital gains tax lock-in effect. You have a greater and greater proportion of people today, 2 to 3 times as many people today would be subject to capital gains tax on their primary residence if they sold their home than what we had 10 to 15 years ago. That is another reason that people aren't very willing to sell. So that's really one of the downsides of buying real estate right now. I think there's plenty of upside in real estate. It's the best place to be, but it's a relative lack of desperate sellers.
All right, a couple of questions I have about things going on in the real estate industry I'd love to get your take on. One is the NAR lawsuit and settlement and fixed commission rates and all that. What do you think about that?
I don't have too many thoughts because I still don't think we know completely where that is going to go. There's a lot to be said for keeping something closer to the old guard structure in place. It's going to change from what it used to be, but that is because if you put too much of the burden of paying the commission on the buyer, traditionally a big reason why that burden was on the seller to pay the entire 6% commission is because the seller is the one that has the equity. That is even more true today. The seller has the equity, the seller has the upper hand, the buyer has the lack of affordability. So the transaction market could really seize up if you put too much of the burden on the buyer with the way things are going to turn out with the NAR lawsuit.
Yeah. So that leads right into my next question, which has to do with equity. You know, you mentioned your first property doing a cash out refinance, using that money forward. What a great strategy that has been. We call that rabbit investing. But then we hit that period of time where there were no more cash out refis. So that tool was lost to us for a little while. Now we're back and we have folks that are third party looking to make these loans, and the government for the first time ever considering second mortgages and HELOCs. What do you think that does for the industry?
I think that helps people free up a lot of this ballooned equity that we have. Equity levels are near record highs. I often encourage people to tap their equity. There can be motivation for doing this if you do this in a prudent way. Home equity's rate of return is 0.
Yeah.
It is also unsafe because you're not protected on the downside, and it's illiquid. So if you have the opportunity to access it, especially with more of the potential coming programs that you're talking about, you need to take a look at doing that. And to bring it back to the principal point here, the return on home equity is always 0. Well, wait, I thought real estate was a good investment. I thought it always appreciated. Well, no, we're just talking about the equity component. If you have $100K of equity in a $500K home, and your $500K home appreciates in value to $600K, let me ask you, did that appreciation amount have anything to do with the amount of equity in it? The answer is no.
Nope.
That property is going to appreciate regardless of the amount of equity that you have in it. The rate of return from home equity is always 0. The thing that you need to be aware of is that you do incur, of course, an interest rate expense when you borrow against that equity. But equity itself has a rate of return of 0, and that should be a motivator for you to consider if it's right for you in separating that. And for me, it is a yes nearly every time.
Yeah. Good stuff. Well, this has been awesome catching up, getting to pick your brain about this stuff. If you want to hear more from Keith, well, you ought to be listening to his podcast if you're not already. Get Rich Education and all your favorite podcast outlets. Great to see you, my friend.
It's been a pleasure, Robert. Thanks so much for having me.
There's Keith Weinhold. You're tuned to the Real Estate Guys radio program. More when we come back. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Are you achieving everything you want in life? What if there was a time-tested way for you to get anything you've dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. And now is the time. Hi, it's Robert Helms. I'd like to personally invite you to attend Create Your Future, the 2025 Goals Retreat, January 17th to 19th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com or call 888-489-7723, extension 18. Get your life back on track, physically, spiritually, and financially. Attend the 2025 Goals Retreat on the third weekend of the new year. Visit goalsretreat.com to learn more and reserve your spot. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723, extension 18 today. goalsretreat.com. As real estate investors, it's no secret that the real estate guys love Florida, and the Sunshine State continues to receive more than its fair share of businesses and population relocating from the Northeast, which has created a huge opportunity for real estate investors. So come join me in mid-September for our Jacksonville field trip. On this highly interactive trip, you'll get an up-close, hands-on, personal experience you'd be hard-pressed to find elsewhere. You'll feel the vibrancy of the markets, observe the quality of the infrastructure, and truly get a sense of the demographics. All things you just can't do by simply searching online. Plus, we'll introduce you to our boots-on-the-ground team, and you'll meet some amazing investors from all over. To reserve your spot, go to realestateguysradio.com and click Events, then Live and In-Person Events, where you'll find the Jacksonville field trip. There's a big difference between researching a market from afar and seeing it with your own eyes. So join the Real Estate Guys September 13th to 15th as we explore Jacksonville and some surrounding markets. Go to realestateguysradio.com and click Events, where you'll find the Jacksonville field trip. I look forward to seeing you there.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to the Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Right around the corner is an awesome event that you need to be at. My friends Ken McElroy and Tarl Yarber annually do an incredible event called the Limitless Expo. This year it happens in Dallas, Texas. Over 2,000 people have already signed up, but there's still some room for you. 50 speakers, including Pace Morby, Brandon Turner, Robert Kiyosaki, Ken McElroy, Robert Helms, and a surprise speaker that will blow you away that they haven't quite yet announced. You get all the details if you just go to limitlessexpo.com. Be sure to enter the code HELMS10 when you sign up, and you'll get 10% off. Well, great to hear from Keith Weinhold. He really has a great approach to understanding investments and always knows the why behind what he invests in. And I appreciate that Keith spends a lot of time educating. And it's fun to go down memory lane back to when he was just thinking about starting a podcast. And now more than 10 years he's been doing it. It's good stuff. And, one of the big things we all have to deal with is the fact that not everything is certain. Nobody has a crystal ball. Your mission as a real estate investor is to get as close as you can to the information in the market you're interested in. And I firmly believe you can only know about 6 or 8 markets well enough to invest in. You don't need to be looking at 40 different markets. Pick 1 or 2 and then get really good. Build a team. Figure out the nuances. And you can do extraordinarily well. And then just get comfortable with being uncomfortable. You're not going to have all the answers. You're not going to get it right every time. But if you keep making corrections and you keep studying, it's not that hard to be just a little bit better than the next investor. Hey, before we get out of here, it's time to take a look at a real estate market. We like to do that most weeks with our Market Spotlight. There are so many awesome real estate markets. On today's Market Spotlight, we'll talk about one of them with our good friend Liz Brody. Hey, Liz.
Hey, Robert. Great to be here.
Well, it's always good to have you here. Mostly, people think of you guys at Mid-South Home Buyers in Memphis, Tennessee. But a few years back, you jumped into a new market, which has been awesome, and that's Little Rock, Arkansas. Tell us about what attracted you guys to Little Rock.
Oh, man. Our investors had been asking us about going there for years and years and years. So it had been on our radar for a long time. And we needed something that could really stand up to everything Memphis offers. And Little Rock sure does. Beautiful homes, extremely landlord-friendly state. Always very important, just the way that Tennessee is. It's a state capital. I think there's some inherent stability with that. It's the international headquarters for Dillard's. Walmart headquarters is located in Bentonville, just out there. It's a growing city. I've known that city for years. My parents grew up there, and every time I go, there's a cute new restaurant, more bike lanes. There's some great universities there, and we have just loved it. And we worked so hard to expand out there and keep our culture. Robert, we permanently relocated 27 long-term employees from Memphis to Little Rock. So we've been there for 5 years, but the folks working on your house have been with us for 10 plus. We're really protective of our perfectionism and our company culture. And so we have the new people. We're here in Memphis. And man, it's just added. We're now at about 700 properties under management there for being there about 5-6 years. The numbers are in. The occupancies are great. The employment for the renters is great. And it's just been working out.
Well, the other thing about Little Rock, it's another one of these affordable markets. So folks that are looking to move into the market, grab one of these jobs, don't have a lot of money set aside, they can rent for, a pretty good rate today.
Absolutely. The price range for Mid-South home buyers as a whole, is about $100,000 to about $200,000. Memphis or Little Rock runs just a little bit higher end than Memphis, but with the same great price to rent ratio. So the cash flows are just as attractive. The Little Rock homes are going to average probably from about $140 to $190 within our price range of about $100 to $200, with a dollar-to-dollar match on the rent. The more the rent, that's what is going to inform the price. And they're just pretty. You can see them on our website. You can sort by state and compare them, and we love it.
It's so interesting how the houses that you guys rehab, the before, they're pretty ghastly, but by the time you're finished, it's all new, everything new, kitchen cabinets, new roof, new water heater. The houses look brand new and beautiful. And let's face it, that is an attraction to tenants. Tenants have choices. All things being equal, they'd rather be in a single family house than an apartment. All things being equal, they'd rather be in a newer looking house than one that's seen some rough times. And so that's always great. Talk about what it takes to get a tenant in, what the turnover time is and those kinds of things. I know you guys have nice long tenancies, but when tenants move, you do have to get the units made ready.
Absolutely. And that is a numbers game that we pay so much attention to. We are a very systemized organization, and we get a monthly scorecard for so many aspects of leasing times to HVAC install, you name it, we're tracking it. And lost rent days or days between move in and move out is something we are a bit obsessed with. And so company-wide across our almost 5,000 house portfolio, the average is 29.87 days or so from move in to move out. You have some seasonal variance. You may have a house on a cul-de-sac that takes an extra week or two to rent, but Mrs. Smith is going to stay even longer since her kids can play in the street. But that 29-day average, that's not to get the paint done. That's not to get a deposit. That's move in to move out. We're really grateful to typically run about 100 renters that are approved and kind of looking to be matched with the house. You hit the nail on the head when you said renters like new kitchens and new bathrooms. We are really kind of one of the only outfits I'm aware of that does new kitchen cabinets every time. Nothing wrong with painted cabinets. I've lived in houses with them, but new is new, and they look really pretty. And we're not just doing kind of new vanities or painting the bathrooms. We're putting in that tile shower surround that's just gorgeous. And that keeps the renters interested.
And let's talk about the numbers, because the numbers always dictate what makes a good investment. You guys actually back into that. So when you pick up a house from Mid-South, it typically has already got a tenant. They're in there. They've been vetted. The house has been completely renovated. You don't have to do much. In fact, more than 90% of your customers don't even come to see the houses. But certainly people are welcome to, and they're beautiful. It's extraordinary how you can go through these nice neighborhoods and pick out the Mid-South houses. They don't all look the same. You've got 4 or 5 different kind of palettes, if you will. But once your eyes trained, you can kind of see your houses.
Absolutely. My acquisitions director, Chris Eulander, he's been with us for 10, 12 years. He tells you we love to pick up the one yellow ugly tooth and a really pretty smile, and then just bring up that one last house. And we back into the whole thing from the rent, and it's why you see such a standardized rent to price and renovation relationship there.
Love that. Well, great to hear about Little Rock, Arkansas. We appreciate your time today, Liz.
Thanks, Robert. Love to be here.
There's Liz Brody. If you want to learn more about Little Rock, Arkansas or Memphis, Tennessee, you can reach out to the fine folks at Mid-South Home Buyers by sending an email to midsouth@realestateguysradio.com. Look for another edition of Market Spotlight next week, as well as registration being open for the 23rd Annual Investors Summit at Sea. We've got an amazing opportunity for you to hang out for more than a week with some excellent investors and an all-star faculty, and it all opens up shortly. You can find out more at investorsummitatc.com. A big thanks to Liz Brody for sharing about Little Rock, Arkansas, and to Keith Weinhold to reminding us that although we can't predict everything, there are some things we can absolutely count on. If you've not heard Keith's show, you can find him at all your greater podcast outlets with Get Rich Education. Next week on the program, we're going to have an awesome guest talking about a market that remains affordable and perhaps an excellent opportunity for you. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.